the big thing we want to talk about today is going to be kind of how we got here. And I used this in a recent video, and I got a lot of questions about. Yeah. Well, what that is for everybody at home watching, this is a year-to-date chart. Actually, this is really 1 year, but I can switch it to year-to-date. It's not going to be terribly different by this point. A little bit different. There's year-to-date from January 1st until December 31st. What you're looking at here is a comparative performance of what happened to Disney this year. And the line, of course, that's at the very bottom on the as you're looking at the screen, the rightmost side of the chart, that 3.93% down there, that orange line is the Walt Disney Company. The line above that, the purple line, is the Dow Jones Industrials. The blue line above that is the S&P 500. And the pink line at the top is the NASDAQ. So Disney, of course, being one of the 30 Dow Jones Industrial components, representing the largest member of the entertainment industry. And the reason Disney is going to probably remain that is because they're one of the few companies that truly is a pure entertainment play. You know, people talk about, well, what about Comcast or some of these other ones? Well, Comcast is still primarily a cable provider. They're a broadband company. They provide internet and cable TV services, who also happens to own NBC and Universal Studios. Whereas Disney is still a pure entertainment, film, television, theme park play. And they're still the biggest one out there. Compare them to Paramount, compare them to Warner Brothers, for example. Disney's still substantially bigger. But as it were, you made less than 4% for the year hanging on to your Disney stock. Meanwhile, the Dow Jones Industrials as a whole did 13.7. And that Dow Jones number would have been, quite frankly, much better had Disney pulled its weight inside of the Dow Jones and actually not so severely underperformed the rest of its indexed group. The S&P 500, the 500 biggest companies, publicly traded companies out there, the S&P, 24.58%. And the NASDAQ, of course, led by the big juggernauts, Apple, Netflix, Google, Facebook, so on and so forth, big tech companies, 44% this year. So if you'd put $1,000 in the NASDAQ, you'd have $1,442 or so right now. If you'd put $1,000 into Disney, you'd have $1,003.93. So I mean, you know, $1,030.90 or $39. I mean, this is how bad it is, right? I mean, this is, and this is going to kind of set the tone for the evening here. We talk
Ron,
about all the
muted
things.
If you're trying to talk.
Oh, Ron, yeah, you are muted. I'm sorry, buddy. I was just about to throw it to you. This is kind of what we're looking at for the evening, Ron. So we're going to talk about how Disney got here, but give me some of your thoughts on this. He's still
can't unmute.
He is. Let me see if I can unmute him.
Did you do it? Yeah, you're muted on your end, Ron.
Oh, yeah, you're muted on your end, Ron. I can't unmute you.
Unmute.
There we are. There we are. Now I got you.
It's less than the inflation rate by far.
Yes. Yes, you lost money if you were sitting in Disney. What do we have, Ron, this year, inflation-wise? About 8 overall, 7 to 8. Much. Yeah, so you got about.
And that's with the really, really unrealistic market basket that they developed, which basically takes out stuff that people actually buy and live on.
Mm-hmm.
So I mean, I think anyone who's actually shopping for a family knows that it's a lot higher than 8%.
Oh yeah. Yeah, the CPI is a bit of a misnomer, isn't it? I mean, people look at that and they think, well, that's what everything went up. Everything went up by the same amount at 8%. But of course, Ron, there's a few things the CPI doesn't factor in. What are those?
Oh gosh. I don't remember what the changes were. I didn't know there was going to be a test.
No. I was going to say, well, you said one already. Food. When you go shopping.
I mean, is that a thing? Is that a problem?
Yeah, I mean, that might want to be in there, right? The grocery store trip, not really factored in the CPI. CPI is far more industrial. Other things not in CPI. Higher education, like college tuition, and healthcare. So, what consistently outpaces the CPI year over year? All three things that we just mentioned. So, yeah, I mean, it's actually worse than what it really appears. But this is Disney's very good or very bad, no good year on display here in pure numbers. And of course, there's a lot of there's a lot of Wall Streeters out there that look at Disney and still want to say, "Oh, everything's fine, all is well. It's going to get better. Just keep sitting in it, right?" And it's like, well, it's kind of hard to look at this and go, "Wow, I sat on Disney stock for a year and basically lost money." And everything else, if I had put it in the NASDAQ 100, if I put it in the triple Qs, I'd have made nearly 50% this year. Oops. I mean, you're not getting that 12 months back.
And yet there was that nice little spike in the fall,
Mm-hmm.
which what was it? Did we ever really come to an understanding of how that happened?
Well, what you had here, this was coming into the earnings call. And this is when Disney started releasing some information about how they were we're going to invest $60 billion of capital in more hotels and parks and stuff like this overseas, not really here in the U.S. And then they had what some people felt like was a fairly positive earnings call, at least in terms of forward-looking guidance. And then again, the reality starts to set in, and it's like, and this was the cross point, right? Here we had right here between November 29th, basically right after Thanksgiving, okay, Disney right here on November 24th was up 10% for the year. It was actually ahead of the Dow, which at the time was 954. And then kind of, I think there's some reality that set in. We saw the box office with The Marvels just completely tanked just a couple of weeks before that. And of course, Thanksgiving week, we got Wish, which absolutely tanked in the theaters. And then look what happened. Oops. Look what happened after that. We got, this thing just went cuckoo. After that, after November 24th, that was right at the day after Thanksgiving, if I'm not mistaken, boop. And then here we go. We said bye-bye. And as
looking at that Disney curve, it looks as if there's what they call what you Wall Street fellows call a support price.
Yeah.
That there's some level that the market doesn't want to let Disney go below.
Mm-hmm.
And if indeed, and when, if the if happens and when it happens,
mm-hmm.
And considering all the news and all the, I mean, maybe there's a hostile takeover premium in there. Maybe that's what's propping it up. Is that a possibility?
I don't think necessarily that's going to be the case because, again, just like right now, and
I mean a proxy fight, not a hostile takeover.
Oh yeah, the proxy. A part of that I think could be, but I don't know. I don't know how much at this point Wall Street really believes that the proxy fight is going to be successful. Right? It's still a tall ladder to climb. It's still going to be difficult for Peltz. Again, most of the time when you make a proxy push, you're trying to. Let me back off on that and say, if you're going to be an activist investor and you're trying to go for board seats and you have enough clout, you get a couple of $1 billion worth of, in this case, Disney stock behind you. Generally, you can have a conversation and you may well wind up with a board seat, provided that you're not, the missing link or something. You're some complete buffoon. Disney has given board seats over to other activist investors in the past 12 and 24 months. But they have been, no surprise, they have been activist investors that are largely in line with and will kiss the butt of Bob Iger. And just, they'll kind of go along with him. They might share, if we do this a little bit differently, do that a little bit differently. When you have a guy like Nelson Peltz, who is coming from a position, and this has been made very clear publicly from SEC filings that we've seen from Disney and all the communications that happened when Nelson Peltz initially started this endeavor a year and a half ago. And it was very clear that Bob Chapek And Ike Perlmutter and Nelson Peltz, quite frankly, were afraid of Bob Iger coming back. They didn't want him to come back. And then he came back. So if you're in a very adversarial position as an activist investor and you're against Bob Iger, then Bob Iger and his little puppet board are going to do anything and everything imaginable to keep you out of there. So he's got the real fight on his hands. These other guys didn't have much of a fight. He will, because he's very much at odds with Iger. And I think he's very well aware that Iger is not capable of fixing Disney, as we've talked about many times before. So,
but that's tonight's theme.
Yep, it is. And if you look at this real quick, this is the last 1 month. This is basically from right after Thanksgiving to where we are now. What do you notice about that chart, Ron? The same indexes, and there's Disney on the bottom.
Yes, in fact, I was just thinking to myself, what is a good metric to describe what happens when not only are you down, but the rest of the market is up?
Yeah,
there must be. I guess that would be performance versus the market, which we're seeing graphically. I'm sure there's some way to measure that crazy funky delta.
Mm-hmm. Well, yeah, I mean, you would look at this in the span of since Thanksgiving, which is about where I backed this up to. From the span of Thanksgiving until today, Disney has lost 5%. The NASDAQ is up 7.3. That's an over 12%.
Which means it's swimming. It's the equivalent of swimming upstream. Except the opposite. I mean, the market's moving up, and Disney is absolutely determined to go down.
Yeah, I mean, it's had a negative beta, pretty strong negative beta here in the last month. I mean, especially when you're a Dow 30 component. I mean, that's usually not a good sign. Disney seems to be stuck in that. I mean, it'll get little lifts here and there as they get some good news, but nobody seems to think there's anything on the horizon that's really worthy of bringing this thing up out of the dumpster.
But look at those the boxes on top. Short term, bearish. Long term, bearish. Midterm, bullish.
Mm-hmm.
There, you see. All you have to do is guess when.
Right.
When's that magic moment when there's going to be something interesting that's going to. I mean, that is a. How do you get to the midterm bullish when the short and long term are both bearish?
Probably because I'm assuming they suspect that they'll have something happy to talk about come early February on the next earnings call, and then it will be short-lived. Yeah, the Marvels will be great. The Marvels and Wish, they get to answer for those foul ups. But I know
Guinea pricing at the parks have been fantastic.
Oh, yeah, absolutely. Make sure you're subscribed to Valiant Renegade and join us every Sunday at 6 p.m. Eastern for the live show.